Tyler, we keep seeing more and more consolidation in the oil patch.
It seemed like it was bound to happen. And I feel like there's no person better that I would want to talk about it with.
So, latest news, Occidental Petroleum is acquiring Crown Rock, about $12 billion in the price they're paying to buy it, debt assumption, all wrapped up. I'm Jason Hall. This is Investing Unscripted. We're going to take a closer look at this deal, try and determine, is this going to create value for Occidental shareholders? And should investors be looking at Occidental as a buy based on this deal and Occidental's existing business? Before we get into the details, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool's got its 10 best stocks to buy right now for you. Be sure to check that link out after watching this video. Okay, Tyler, what happened?
If people haven't heard of Crown Rock Resources before, that's probably not a shock. This was actually private companies. It's been a lot of the chatter in oil and gas merger acquisitions lately is a lot of these private oil and gas companies that have been like roll-ups by private equity, just buying acreage, and then folding them into these single assets, Crown Rock being one of them. The deal itself, $12 billion with the debt assumptions built into it. It's not the biggest deal that Occidental has ever done, but it's not the smallest. It kind of reminds me a little bit, just a smaller degree of the deal in 2019 to go for Anadarko Petroleum, which levered the company to the nose.
Well, for those that don't remember, it was a highly competitive deal. They kept raising their price, and they raised it to a point that basically, frankly, they couldn't afford the price. And Berkshire Hathaway, Warren Buffett, made some very Berkshire Hathaway favorable deals to lend the money to backstop Oxy to get the deal done. And it's easy to forget that happened because the pandemic happened and everybody thought all the oil companies were going to go bankrupt anyway. And then everything got better. And then the past several years have been really good for the oil industry writ large because of high prices, relatively high demand. And a lot of the companies, Oxy included, have deleveraged and have focused on efficiency and generating better cash flows from better assets.
Prior to the Anadarko deal in 2019, they had $9.2 billion in debt. After the deal, they had 43.9. This is an $80 billion enterprise value company. So, that's a lot of debt. And then, as you said, they delevered a lot, favorable oil prices brought them back down into like the $17 billion range prior to this. But again, we're going to add another 10 to that. So we're up in the 28, 29 range in terms of total debt going to be on the books at Occidental Petroleum, which doesn't sound like the scariest thing in the world, but it also builds on some optimism on oil prices. They say in the deal it's immediately accretive to earnings and cash flow at more than $70 West Texas Intermediate. Well, I think we're actually below that today.
I want to stay on that for a second, Tyler, because I think it's really important. Is what we've generally seen for a lot of these deals more recently is, as this consolidation has happened, when the companies are issuing those press releases, they're not really talking about current market prices as their profit level. They're talking about pretty conservative prices to backstop the deal making sense.
There is a decent amount of production on hand at Castle Rock that is low enough. They can do plenty of things rather well. Whether or not they're going to be drilling their $70 a barrel inventory anytime soon is a different question based on where we are at oil prices right now.
Let's break that down. I think that's a good thing to discuss. So they have 1,250 development ready locations that are break even at sub $60 West Texas crude. A big chunk of locations, 750, that are sub 40. So you're talking about a substantial amount of its inventory that can be very profitable at lower prices. And I think that's the thing that they should be leading with and highlighting. So that's good. Okay, so we've talked a little bit about the fact that they're levering up again, right? Uncle Warren came in to save them and made a good bit of money on the way the last time they did this. And so they're levering up again. And here's a couple of aspects of this that I think are pretty important. Number one, we don't know the terms of the debt yet, right? We don't know what the debt cost is going to be. So we still don't know what the cost of capital is for this deal, right?
No, we do not. I'm assuming when the deal actually closes and we get closer to that, they'll actually have to do their capital raise for it. And that's when it happens. But all of these deals, they got to go through the legalese.
That's true. And I think we can assume that the debt is probably going to fall somewhere 6 to 7%. Again, depends on the term, the exact numbers. But in this current interest rate regime, I think it's reasonable to say it's probably going to be somewhere in that 6 to 7% range. Let's think about what they're buying. Assuming that the amount of production they're buying, they're going to boost their production by 11 or 12%, I think, round figures.
They're also planning to sell some other stuff too. They want a $4.5 to $6 billion divestiture program. So netting out, they're going to have a much lower amount of debt that they actually have to take on relative to the entire size of the deal. But again, you're buying 12 to sell 6. So I don't know. This is one of those ones where you look at it and you can go, maybe it's good, maybe it's not. I don't know. But Occidental is one of those as a business is kind of hard to discuss without like the Berkshire Hathaway shadow cast over it. It has the blessing of Warren Buffett. And so most market participants treat it as a very favorable company, as a very, very good one. But, moves like this are very aggressive. And being extremely aggressive in the oil patch can bite you in the butt. And it has happened once with Occidental before. And I'm not saying that it's going to happen again, but it's not beyond the realm of plausibility.
Yeah, I think where I stand right now too, you think about where the stock trades for around 8 times trailing cash flows. And of course, their free cash flow, like every oil producer. And again, they're a little bit integrated, but they're still primarily oil and gas. Production is the vast majority of their earnings and their cash flow. And their cash flows are still coming down because oil prices have come down. And we're just about another quarter from lapping the higher prices. So you have to think about that in the valuation too, that it probably still trades for close to double digit what its forward cash flows are going to be. Again, assuming oil prices stay relatively close to where they are. And I don't think that makes it cheap, particularly when you're adding more debt, taking on more assets you have to integrate into your operations. It's still a little unclear to me how much adjacency benefit it gets with those. They're in the Midland Basin, where they have a lot of production. So probably some decent what's the word that the M&A guys always like to talk about?
Synergies. Is that the term you were looking for?
Synergies. We don't know if the supposed synergies that always get talked about with these deals are really going to play out. Maybe they will. Maybe they have abutting acreage where it's going to be really easy to like have their drilling contractors work and they can extend laterals and all that kind of stuff that make it really cost effective. We don't know all of that stuff. It's hard to say exactly how much value that's going to create. I think this is definitely a wait and see opportunity. I think investors that are looking at Oxy probably should just keep watching right now and keep learning more, find out what the cost of capital is, learn a little bit more about the value of the assets they're bringing in, see where oil prices are going to be, and maybe think about adding on opportunities down the road. But I don't think we're there yet either.